I'm Ben Reppond. Welcome to my YouTube broadcast. Today is Wednesday, June 28, 2023. We'll get into the what's going on in the stock market. This is from last Friday, so it's not quite up to date, but it's close. This would be reporting on last week. So this are what I have here, going down the list, 7 indexes. 6 equity indexes and the long-term government bond index. And they're measured from top to bottom from the highest rate of return year to date in the pink box. And you can see the NASDAQ 100, the QQQ, is definitely by far the highest achiever, 36% year to date. Above, the 4 dots represent above its 20, 50, 100, and 200-day moving averages. SPY, representing the S&P 500, is up 13%, and it's above all 4 of its moving averages. Both of them, however, last week in the yellow box were down 2%. Matter of fact, all of the equity indexes were down last week, and the only one that was slightly positive was the government bond index. So you can see in the yellow box, they ranged from down 2% all the way emerging markets down 4.5%. So it was definitely more of a down week, and that pulled the rates of return for the year down from the previous week. The red dots represent, in each of those cases, the if they were below their 20, 50, or 100 or 200-day moving averages. So going down the list, NASDAQ 100, S&P 500, developed countries. TLT is a long-term government bond. IWM is the Russell 2000 Small Cap Index, and EEM is the Emerging Markets Index, and at the very bottom, the Dow Industrials. The Dow Industrials are only up 1.77% year to date. So while you think of the S&P up 13%, it's, as I said yesterday, that's driven by 7 stocks. The rest of that market in the S&P 500 is negative. So there's a distortion there. It's not it's the best example we have of a broad market index, but it's not, these are not broad market returns. These are captured in the few stocks. The rest of them are very low or negative. On average, negative. When we look at the S&P 500 and break it apart into its 11 sectors, very interesting. You can see in the pink box, again, this is measuring top to bottom. The top is XLK, which is technology. The next one after that is consumer discretionary. They're up 33% and 28%, and then it drops way down. Then you have 3 indexes, 3 sectors that are the industrials, basic materials, and retail, that are up slightly. Beyond that, the last 6 are negative sectors year to date. So again, you see that consumer discretionary and technology are basically holding up the market. The rest of the market is minimal returns or negative. That goes all the way down to energy at the bottom, which is down 11% year to date. Continues to drop. And telecommunications sector and the energy sector are both below all of their 20, 50, 100, and 200-day moving averages. So a very different picture. And then you can see for the week, in the yellow box, last week, every single sector was negative. An interesting view, rather than just think of, oh, the S&P is up 13% year to date. Things are good. Part of it's good, part of it's not so good. The S&P 500, you can see this goes from October to through last week. That dip at the end on the far right of the chart is what I was just saying. That's where the S&P was down a couple of percent for the week. But it goes up and down, but it is still in an upward trajectory. And even with last week included, this is an 18-month weekly chart. When you look at the two components, not 11 components, but two components of the S&P 500, they are either growth or they're value. Growth stocks tend to be more the technology that are oriented to growth. They typically don't pay dividends, or not very many of them do, and they put their money back into growth. And value companies tend to be more old economy stocks, and most of them pay dividends, and very different kinds of companies. So as you can see, last year, all of last year, through most of last year, when this goes down, it went down, that favors value, which is the denominator. When it goes up, that favors growth, which is the numerator. This year, from January 1st, turns out, pretty much right on January 1st to present, you can see it's going in an upward trajectory that favors growth stocks. And value is out of favor. That's well represented by the data that I just presented, showing the Dow Industrials, which tend to be value stocks, only up 1% this year. And a number of the sectors are negative this year compared to growth or the technology stocks, which are up substantially this year. When we look at the S&P 500 compared to the 500 largest companies in the country, compared to, or in the stock market, compared to the small cap companies, those that are typically under $2 billion in valuation, we can see that from March to present, look how much large companies have outperformed small companies. So again, very much a bifurcated market, not just in growth and technology, consumer discretionary, but in large companies versus small companies. A lot of non-participation in this market. So if somebody says, I own an individual stock, this one and this one, and it's doing really well, okay, you're in the right sector. But a lot of people are part of that 493 stocks that aren't doing very well, and they may be negative for the year, even though the market is up. The long-term government bond is, since December of last year, actually back into November of last year, has been in a sideways movement and actually slightly down, and kind of right at its 20-period moving average, but is not really participating in this rally, kind of going sideways to nowhere. The dollar continues to decline. It rallied up until October, and then from October to present, it's been, generally speaking, in a period of decline. Gold went down last week, went down the last couple of weeks, and I represented that by the black arrow. However, since last October, it is up, but it's not, in my opinion, it's not trending up. It's up, but there are periods of correction like the one that it's going through right now. And silver even more so. Even though it's up, I think the trend that I see here is more of a short-term downward trend than the larger trend from October, which is technically positive. When I compare the two, even more so. When I put silver as a numerator, gold as a denominator, and look at the ratio and plot that ratio, you can see that the short-term move is that gold is in favor Even though both are down, gold is down less than silver. Even though from last September, you could say that silver is higher than gold. But a lot of up and down movement, and that does happen with precious metals. Bitcoin had a very good week. It is up significantly, and you can see that through the move up at the end, and there is clearly a trend that is moving in an upward direction from the beginning, approximately the beginning of 2023. Volatility index, now this is interesting, I can't explain this. The volatility index is down at 13 and continued to stay either flat or declining in the face of all 11 sectors. We saw this, all 11 sectors of the S&P were negative, and the volatility index did not respond by going up, which I thought it would, but it didn't. So you can see from March to present, the volatility index is declining. So, and that's generally speaking good for equities, or at least through last Friday was good for equities. Asbury Research, and this is called the Asbury six technical indicators, mostly technical. 5 of the 6 are positive. However, no surprise to me, excuse me, based on the lack of breadth in the market, that the breadth indicator is negative. That showed up in a couple of ways. One is by the small cap being way underperforming large cap. We saw that chart. And no surprise that growth, and particularly these 7 stocks that are holding up the market does not have breadth. It is in a few leaders in the market, and historically that has not been a good indicator for growth. The cross-asset relative performance chart shows comparing one asset or one type of equity to another. So going from left to right, this is the last week, the last month, and the last quarter. So they're all short-term, measured in those time periods. So going down the list, the ones that are hit all 3 boxes of weekly, monthly, and quarterly are large cap versus small cap. We saw that clearly. Large caps in favor. Broad market, the S&P 500 compared to the blue chips, the Dow Industrials, the broad market is better. Technology versus the S&P 500, technology is better. Growth versus value, we saw that also. Growth, better. U.S. versus the emerging markets or the developed markets, U.S. is better than both. And bonds, the long-term versus the short-term bonds, long-term is better than short-term. U.S. versus the world. So this shows, again, same weekly, monthly, quarterly, that the U.S. is slightly better than all of these countries or regions in the world except Brazil. But not enough, not decisively. More like a sideways chart, but barely up. So that would not get a green box. It would need to be in more of an upward trend and more decisive to get the green boxes. So Brazil is outperforming a developing country and third world country, not a wonderful country, but not part of the, certainly not part of the G7, and but they're outperforming the U.S. I show a chart, a 3-month chart, because that measured 3 months of EWZ versus SPY. EWZ, the Brazil ETF, is clearly in an upward trajectory relative to SPY. So let's say, for example, let's say SPY, S&P 500 is down, and this is down less, you would still get an upward trajectory. If they're both up, but this is up more, you'd still get an upward trajectory. So it's relative performance of one versus the other. Okay, gold and silver. Gold is, as I told you earlier, down 1.9% for the last week through Friday, and the spot price is $19.24 before you add the markup to it. And silver is $22.47 spot price as of last Friday. That is down 7.3% from the previous Friday. So you saw this in the gold and silver charts, those lines down at the end. That's represented by this. The gold-silver ratio favors silver as a better buy because the gold numerator, silver denominator is 85-1. That is a range that is says silver is a better buy than gold when you look at it from the standpoint of the gold-silver ratio. A monster box is $12,045. This is from my son Preston, who's in that business, and these are his prices. That includes $1.62 per ounce markup. That has come way down. I cannot explain. I didn't talk to him. I can't explain why that is, but it's down from over $4 down to $1.62. It's getting down in the range where it was many years ago, down in the dollar plus range. The monster box has 500 coins in it, and the cost is $24.09 per ounce, including the markup for 500. For 20, it's $24.34. The bulls are saying, one says to the other, I don't like the looks of this, Marv. So there's storm clouds on the horizon, and the bulls are feeling it. We've had a nice run. I don't know how much longer it's going to last. Mike Wilson from Morgan Stanley continues to say the risk is getting higher and higher. He's never seen it so high. But yet, those 7 tech stocks are not listening. The rest of the market is, but they're not. But the bears are lurking. Thank you for watching. If you have questions or comments, leave them in the comment section below.